Okay, so there's this rule of thumb, and my husband is a trader, and I always find it really funny. He would say the minute your Uber driver or your taxi driver starts to talk to you about a stock to invest, that is absolutely the right time to sell that stock because it is going to the dogs. The minute it becomes very, very well known on the market, the the returns are going to decline because everyone's going to jump into it. That was just a little bit of a fun note. So for those of you that don't know me, my name is Uzo Ijiwere. I run a consulting, coaching and training consultancy called Augment Results. I'm the managing director and the founder of that. And we serve mid to large size organizations in the FTSE 250, providing their coaching and EDI training needs. I also founded Women Build Wealth, which is probably how you've come into this masterclass today, because I just had it on my heart that I wanted to support others in areas where I was challenged or have had challenges and have found solutions to. And so I started this social enterprise to inspire women with the confidence to build wealth, to manage their well-being, and to build strong relationships. And finally, I'm also a co-founder of a company called Voxo, which helps professional women to find their voice in the workplace by offering speaker training. Okay, so that's me in a nutshell. These are just some of my clients since we started, well, since I've been in corporate life about 2 decades ago. I've worked and had the opportunity to work with so many amazing organizations. Right, so let's get to what we want to talk about today, which is all about investing in businesses, right? And in my promotion, I spoke about one of the key fears of women is the fear of losing money, and that's stopping women from investing or making investments into opportunities that come across their desk or their path. And there's a few interesting statistics that I want to share with you. Women are less likely to invest their money, and so they're missing out on higher returns. These statistics I'm about to read out all come from a very significant study delivered or researched by, I think it was Fidelity a few years ago. So the fear of losing money, as I've just said, is a key barrier. But the research also found that women found it difficult to decipher investment language, financial language. It was complicated, it was intimidating, and for some, it was downright incomprehensible. And that's one of our missions here at Women Build Wealth, to simplify and to allow access to those areas where you felt as a woman out of the room, not being allowed into the room. Now, I have a financial background, so I'm able to kind of cobble through these things. But there's so many people that are not investing because they think they're not smart enough. And that's just plain untrue. And the reasons why we need to start to think about this as a body, women, is because the gender pensions gap is so large. It means that there's almost 11% difference between our pension pots and the pension pots of men at the time of retirement. And so with just a little adjustment, for instance, an extra £35 a month invested, we can bridge those gaps. It doesn't take too much to do. So what I'm be talking about today are investments are as far and as wide as you can imagine, but what I'm speaking about specifically today is stocks, shares, and perhaps, excuse me, an investment in a going concern in a business. Now, just for simplicity's sake, like I say, we're trying to make it so that the language is simpler. An investment is something you buy or put your money into to get a profitable return. Okay, please don't feel patronized in any way. I don't know who's going to be watching this, so I think it's important to define things wherever possible. So today, the metrics I'm going to share with you can be used to decide about stocks and shares, investment in those, but also investments in businesses, which I think is definitely an area of interest for a lot of people. You could use some of these metrics to assess a property investment, but it's less likely that it will help you in deciding, oh, I want to buy property A versus property B for my use. And it will be more useful for you if, say, you're trying to put your money into an investment fund that focuses on property or some sort of other property investment vehicle. Okay. Right. So I thought I would start off with a case study because these things are very interesting. I decided to put this workshop together, this masterclass together, because I was having lots and lots of conversations with young people, particularly in Nigeria, but also here in England. And they're talking about, oh, that a friend of theirs that just got scammed, XYZ just lost a lot of money, they don't know what they're going to do. And when I started to dig a little bit and ask questions, I found inevitably that the fundamentals of the businesses kind of were red flags, and they could have, with the right knowledge, not lost that money. So Tingo, I'm sure some of you out there know this organization. It was originally established in Nigeria in 2001 and grew its operations across Africa, the Southeast, Asia, and the Middle East. Now, according to its website, Tingo Group is the leading agri-fintech company operating in Africa. The company says it offers app-based services to 32 million farmers worldwide, with a seed to sale marketplace platform, insurance, microfinance, and mobile phone services. So I took that directly from their site. Now, let me tell you the story about Tingo. So Tingo in 2013, they had 2 mobile phone assembly facilities set up in Nigeria. Now, Tingo Mobile claimed that these facilities had produced and distributed over 20 million mobile devices. In early 2020, the company had the former president, Goodluck Jonathan, and some other luminaries, Nigerian Minister for Trade, Industry and Investment, and Mr. or Chief Aganga, were on the board as well, as at 2020 June. In June 2023, NASDAQ listed shares in Tingo plunged in value after a report said that the company was an exceptionally obvious scam. Now, Tingo didn't like this. They fought tooth and nail that, those slanderous comments and they should be taken back. And, we're going to sue and all of that good stuff. But on the 13th of November, 2023, the United States Securities and Exchange Commission, almost like the regulatory body that watches these organizations, the SEC, halted trading in Tingo Group shares and that of the related entity, the AgriFintech Securities, after finding inaccuracies in their disclosure. In December 2023, the SEC announced charges against the co-CEOs and the 3 US-based entities alleging fraudulent financial claims to defraud investors. Apparently, Deloitte International Audit Arm certified that the Nigerian firm Tingo had $470 million in the bank. When the SEC went looking after the allegations, they found only $50 in the account and billions of dollars in fictitious transactions. As at 2 months ago, Tingo filed to voluntarily delist from the NASDAQ, and that is the end of that business. Now, you can say, oh, wow, gosh, they found the scam. But we aren't talking about all the millions of people, all the millions of, investors who've lost, for some of them might have been a significant portion of their wealth, the emotional turmoil, because if you are so invested and you so believe in an organization, and for it to be showcased to be smoke and mirrors, there's damage that comes with that. You start to doubt yourself. You start to wonder about your judgment. Okay, so at Women Build Wealth, we promote having a long-term view and not being led by trends or fads or celebrity endorsements. You really need to take the time to develop your own knowledge so that you aren't susceptible to these types of scams. Okay. Right. I want you to meet Mary. Now, Mary's a former secondary school teacher turned homemaker who raised 3 children alongside her supportive husband. Now, when Mary was about 45 years old, her routine often led her to, go to the market, to buy some things. And she happened to like one particular market. And so she would frequent there a lot. Now, whilst going back and forth and frequenting this market, she grew familiar with Nike, a friendly, stall owner, a young lady who owned a little store and sold some merchandise, which she really liked. Nike was nice and bubbly. She had exceptional customer service and a really warm personality. And as you do, I mean, in Africa, you have your customer, as you do, over time, you develop like a little friendship. There's a bit of banter if you're a loyal customer. Now, Mary was witnessing Nike's business flourish, transitioning from a store to a shop within the market, and then she expanded into 2 shops. And this impressed Mary, as she went and asked Nike, how she was doing it, how was she growing like this in such a short space of time? And Nike was happy to talk to her about her business, about her vision, and how she wanted to achieve everything she'd said she was looking for. Now, inspired by Nike's strategy, Mary decided that she would talk to her husband about investing in Nike's business. She hadn't been asked for an investment, but she saw something that she thought was interesting. And so she took the initiative and proposed her interest to Nike. She went to Nike and said, okay, I don't know if you're looking for some investors, but you told me your vision and I think XYZ, okay? Fast forward to today, Mary, who's now 65 years old, proudly holds a 5% share in Nike's thriving department store, which boasts 6 floors of exquisite merchandise. I have visited this store. It's amazing. And so, I love this little case study. I haven't used the real picture, but I love this little case study because Mary's journey from just being a market patron to an investor reflects her astute observation, her patience, proactive decision-making, and trust in the evidence presented to her by Nike. What effectively Mary did was her due diligence. Doing your due diligence before investing is crucial to minimize risks and increase your chances of success. It means thoroughly researching and analyzing investment opportunities to make smart decisions. By doing due diligence, you can understand the potential risks involved. You can evaluate the true value of the opportunity, and you can uncover any legal or compliance issues right up front, rather than being a cautionary tale for someone else later on. So this knowledge helps you to negotiate better terms, to manage your risks effectively, to set yourself up for long-term success. So whether you're looking into a new business venture or an investment opportunity, or you're conducting your due diligence is key to being confident, making informed decisions. Okay. So there are several ways to assess investments, but it can get quite technical, which makes people shy away. And that's the whole point of this talk, to reduce those barriers to entry. When I was considering what to discuss today, I had to focus in on the most important things I think everyone should know or understand, but also how to ensure that it was bite-sized enough and digestible enough that you would know how to go and utilize it. So for that, for those purposes, I'm not going to be sharing any equations of how to calculate things. All of that is available on the internet. Google is your friend. Use it. I'm just going to showcase which aspects of fundamental analysis you should be applying, and then you can go and further educate yourself in line with our ethos here at Women Build Wealth. Okay. So fundamental analysis, let me define that for you. It's a way to figure out how valuable a company is by looking at its financial health, management quality, and its place in the industry. It involves studying particular things to decide if a share or investment is worth buying, i.e., if it has growth potential, because that's the whole point, right? By taking this fundamental analysis approach, it will help you make smart decisions based on the company's true value rather than just how the market is doing in that moment, or worse, what is trending, because that's another buzzword now. It's trending, let's get on the bandwagon. It's very, very dangerous to do that because you don't know if you're the last person at the bottom of that pyramid. Okay. Some of you might know this gentleman, this very distinguished looking gentleman. This is Mr. Warren Buffett, one of the richest men in the world. And he's also called the Oracle of Omaha because he's from Omaha. And he's a famous investor who uses and has always used fundamental analysis. He famously promotes the idea of thoroughly researching and understanding a company's fundamentals, its health, financial health, its management team, competitive advantages, and industry position before making investment decisions. So he believes that by focusing on the intrinsic value of a company, and the phrase the intrinsic value, that is what I mean by that is the true worth of an asset based on its fundamental qualities like earnings and potential, rather than just its current market price, as well as looking at its long-term prospects rather than short-term market fluctuations, is the way to properly make a decision about where you're going to put your money. Doing this, you understand, you're more informed rather, and you make more profitable decisions. So I'm sure there are several shares and companies that you know right now that when you hear their share price, you blink and you think, huh, how is that possible? Why are they trading at that price? Or why are we being asked to pay XYZ? Now, why are they being valued so highly? Please listen to yourself when that happens. Your spidey senses are probably telling you to dig a bit deeper. Okay. And also listen to Mr. Buffett. Listen, at 134 billion net worth, and that's live as of yesterday. I took that screen grab. He knows what he's talking about. You are in charge of the decisions you make to build your portfolio. It doesn't always feel like that. Sometimes there's this pressure to get in before the opportunity is gone, to make sure you take a leap, be the man or be the woman, and come on, put your money where your mouth is. Oh, you're just gonna sit out and not going to take charge. All of those things are wonderful, but what happens is when the investment goes bust or things go wrong, all those people that were telling you to be a man or be a woman, or to come on, to move before the market is late, nobody's reimbursing you for your loss. So I would say, remember that you are in charge, you are in control, and make your decisions based on data rather than on sentiment. Okay. There are several metrics you can look at under fundamental analysis, but for today, we'll focus on a two-pronged approach I like to adopt. I like to look at what you should do before making an investment, and then also the information you should request, or rather your prospect should provide if they want your money. And you should be doing all of that before you hand over a dime. So metric, and you can see I wrote action 1, invest in what you know. Investing in companies that you are familiar with and understand well is crucial, especially when you're starting your investment journey. When you invest in familiar companies, you have better insight into their products and services and how they operate within their industry. This familiarity allows you to evaluate their growth potential more effectively and assess the risks involved. Now, take the little story about Mary. She didn't meet this lady in the stall and go, oh, great, here's a bunch of cash. She understood that market. She understood the demographic of the people that shopped there. She understood the products that were being purchased. She understood what Nike was selling. She understood the demand and the supply of those products. And based on all of that information, she felt comfortable to make the next step to invest. she essentially did market research, right? So now market research involves gathering and analyzing information about a company's industry, the customer's preferences, market trends. By combining your understanding of the company with a thorough market research, you can make more informed investment decisions. Now, Nika wasn't a company, but she was, wasn't she? She might have been just one person, but she was operating a business. So, regardless of the size of the business, this fundamental, this approach of investing in what you know, it bears out, it works because you can see it's like people that like invest in McDonald's, for instance, right? You know that an investment in McDonald's is a safe bet because people continue to eat McDonald's. You go into McDonald's yourself, you can see if the service levels are dipping or falling. And if they are falling, you start to think, why is nothing being done to address that? Does that mean that there's going to be less customer demand if that continues? Or if you see that, customer service is wonderful, the food is okay, as okay as McDonald's can be. Service is the people are still coming when you go, there's a queue to buy stuff. It informs your decision. Okay. So market research is key. Finally, in understanding the investment, knowing about the business, you don't have to have known them for a long time. You could just learn about them. That's what the market research is for. But also, don't underestimate the importance of a good team of people driving a vision forward. Now, if a business is new, but the management team have a proven track record, then you can rely on that when making your decision. Okay, so dig into it. Who is involved in this business? What is their CV? Okay, what have they done previously? Oh, they were involved in PayPal. I'll just use Elon Musk as an example. Oh, he was part of the team that created PayPal, and now he wants some money to go do Tesla. Well, PayPal did well in it. So let's see whether, this next thing he does is going to do well as well. We have these little stories all around us. We focus on the very big stories, but they're happening next door to us. They're happening at our offices. They're happening with friends of friends. So look out for that. Okay. Metric 2 is the revenue growth rate. So the revenue growth rate is a measure that shows how much a company's sales or total income has increased over a specific period, and is usually compared to the previous year. So a higher revenue growth rate generally indicates that a company is selling more of its products or services and experiencing growth in its business. This metric is important for investors and analysts to assess a company's performance and potential for future expansion. Now let's take Amazon as an example. In 1997, when Amazon went public, its stock price was $18 per share. By 2021, its stock price reached over $3,000 per share, representing a return of over 16,000%. Yes, you heard me right, 16,000%. One of the key metrics that growth investors used to assess Amazon's value earlier on was its revenue growth rate. Despite posting losses for many years, Amazon consistently grew its revenue at a high rate, indicating its ability to capture market share and diversify its business segments. So for instance, in 2019, Amazon's revenue grew by 20% year on year to $280 billion, while its net income increased by 15% to over just under $12 billion, right? So assessing the revenue growth rate is something that will indicate to you what the potential is for this business. Is it stagnating? Is it rising year on year? It's a safe bet. It's a safer bet. There's nothing that's a safe bet. It's a safer bet. Okay. Cash flow. So usually when we talk about cash flow, just as lay people, normal people, we're looking at our bank balance and thinking, gosh, how am I going to, I have this big payment coming through, and is there enough cash in there? And oh my goodness, these kids are eating me out of house and home, and oh Lordy. Yeah, we understand cash flow as humans, right? Or adult humans. But a free cash flow is the amount of money a company has left over after paying for its expenses and investments in things like equipment or buildings. Okay, so this leftover cash can be used for various purposes like paying dividends to shareholders or reducing the amount of debt that the company owes or investing in new projects. So essentially, it shows how much cash a company can generate that's available for other uses beyond basic operations. And this really helps investors understand the company's financial strength and its ability to fund future growth or reward shareholders. So, in a nutshell, you would say if a company's free cash flow was high, then you know that you're likely to get your dividend as a shareholder of that business that year, as opposed to not being paid it because they had to retain the capital. Okay. Let's continue with that Amazon case study. So Amazon's free cash flow increased from 6.5 billion in 2015 to 26 billion in 2019. And this, of course, indicates strong cash generation and financial flexibility. Okay. Now, if your investment prospect isn't a stock, but an investment opportunity presented to you by an individual you were introduced to, or maybe you have a friend who has a business that they're asking you to invest in. If they're a going concern, then they should be able to present you with this cash flow metric rather, because they have to track it. And if they cannot answer this question about free cash flow, then back and also back it up with evidence, right? Please back away, run in the other direction. Something is not quite right. They should have answers to these types of questions. The debt equity ratio shows the relationship between the money the company owes and the money invested by shareholders, their equity. So the money the company owes, which is its debt, and the money invested by shareholders, which is equity. A higher debt to equity ratio indicates that the company relies more on borrowing to finance its operations. And this indicates that it's riskier, right? Because it means that the company has more debt to repay. If anything goes wrong, if a sales cycle was not as profitable and they weren't able to get in as much revenue as they planned for, but they still had to make a debt repayment, there would be an issue, right? If it won't balance. So, this is an indicator of risk for the organization, or the risk to which it is exposed. On the other hand, a lower debt equity ratio suggests a more conservative financial structure with less reliance on borrowed funds. And so it's a less risky proposition. So a prudent debt to equity ratio can instill investor confidence because it demonstrates that the company is managing its capital effectively. Okay. Competitive advantage. As I said, I'm a finance student and business graduate as well. And so, we talk about having a competitive advantage, and I think a lot of people understand what this phrase is. But again, please forgive me if you feel it's a bit patronizing, but I think it's important to define these things. A competitive advantage is something that makes a company stand out and perform better than its competitors in the workplace. It's a unique strength or characteristic that allows a company to attract more customers, charge higher prices, or achieve higher profits compared to others in the same industry. Okay. Having a competitive advantage is important because it helps a company maintain and grow its market share, leading to sustained success and profitability over time. Okay, I like to give practical examples. So now let's use another company, Netflix, as another case study. In 2002, when Netflix went public, its stock price was $15 per share. By 2021, its stock price reached over $500 per share, which equates to a 3,000 plus % return on investment. Okay. Now, one of the metrics that investors use to gauge Netflix growth potential was its content spending. Now, content spending is the amount of money that a company spends on producing or acquiring content for its platform. Of course, we all know Netflix is a viewing platform. Now, it measures how much a company invests in creating or enhancing its competitive advantage over other organizations in that space and attracting and retaining customers. So Netflix content spending has been increasing steadily over the years, indicating its commitment to offering high quality and diverse content to its users. So in 2019, it spent 15 billion on content, and that was up from 2018, where it spent 12 billion in content. I tried to find more up-to-date data figures. I couldn't get the numbers in enough time to put it in here, but you can imagine, given the state of the market now, with Disney having created its own streaming platform in the last couple or 3 years and really pushing that investment, as well as the others, you can imagine the competition, or the competition is hot at the moment in this industry. But for a huge amount of years, Netflix was by far the front runner, the only one, the GOAT in that industry. It had an obvious competitive advantage, and therefore it was able to just cream off the top in the market. Okay, so when you're faced with an investment decision, ask yourself, what is it that makes the company different from other companies? What is its unique selling point, its USP? In the car industry, that's another case study for you. Tesla was the only company investing heavily in electric cars a decade ago. Now, the rest of the market, as we can see, has caught up there. I mean, goodness me, every other where you turn, you hit an electric vehicle of some sort. They're just coming out of the woodwork. And so they're all developing, the same technology now. What's Tesla done? They're off going forward, developing self-driving technology. So they continue to create this gap in the market where they are ahead of the curve, where they are innovating and creating. And you can debate as much as you like whether Tesla is at the right valuation at the moment. There's a huge amount of debates about that all the time. Is it too expensive? Is it too expensive? But you cannot argue with their competitive advantage. And so the question is, okay, so does that lead to true value? Is it real? And it's, yeah, who knows? I won't even stipulate, but that's a way to assess. Okay. And we've gotten to my bonus metric, last but not the least. And I've included this metric, the CapEx to sales ratio, capital expenditure to sales ratio, because scams are on the rise and you cannot believe your eyes sometimes. And that's why I wanted to include this one. This metrics, you can use metric you can use to for short stocks and shares, but also if your friend tells you about this hot opportunity that you must not miss out on, you want to know if you are the last Mugu. And for my international audience, the word Mugu then means fool, whose investment is going to fund a lavish lifestyle for the executive team running the business rather than be used for growing the company. So the capital expenditure to sales ratio compares the amount of money the company spends on capital expenditures, investments in long-term assets like equipment, facilities, or technology, and compares that to its total sales or the revenue. Okay. A higher capex to sales ratio indicates that the company is investing a large portion of its revenue back into the business to expand operations and improve efficiency. And this suggests a focus on growth and future profitability rather than excessive spending on, non-essential luxury items, lavish travel, lots of comped meals and entertainment and things like that. Okay. So investors should look for a healthy balance between capital expenditure and sales because it demonstrates that management is committed to investing in the company's long-term success and is working for you, its shareholder. Okay, so I told you I would do the heavy lifting. It was a quick lunch and learn. I hope that you found that beneficial. I leave this slide in all of my lunch and learn presentations because don't be put off by things being challenging at the start, middle, or end of your journey. Difficulty inevitably means growth. So rejoice in the fact that things are hard initially and then they become easy. And don't let anyone or anything stop you or stand in your way. Okay. I hope those 5 metrics are going to help you to take a step back when you are presented opportunities sometimes, often, you immediately know because you think this is too good to be true. If it feels like that, it probably is. But you never know. There might be a gem, a diamond in the rough. Use these metrics, ask the questions, do your research yourself, and dig a bit. Utilize the data in front of you and do not be driven up or caught up in the waves of emotions of others going, oh, this is it's coming, it's going, it's leaving, we must get in, we must get in. So much easier to take a slow and steady approach. Be patient, take your time, build, compound, and it will come. Okay. Please do follow me on Instagram, LinkedIn. Those are all our handles. Uzo Ojewere, Women Build Wealth, Augment Results. LinkedIn, it's Uzo Ojewere. And please do sign up to our, go have a look at our website, www.womenbuildwealth.org, for loads of amazing blog posts and articles and tools that you can utilize in building your wealth and going on your own financial independence journey. And do come and join us in our Women Build Wealth Facebook group. Send your application to join, and we'll see you there. Thank you so much for your time. It's been a pleasure.